What's up, guys? Welcome back to the Bumpy Road to $10 million. If you're in your 20s or 30s and are thinking about how to grow your money in the stock market, this series is for you. As a reminder, this video is not financial advice. You should always do your own research before investing. As we said in the previous video, we are hoping to replicate the results of this chart with a long-term investment strategy. And our experience is far more likely to look like the volatile green line here than the smooth blue line. Now, what can you expect moving forward? This will be a series of around 10-minute videos released weekly. I will try and make the series on the whole as comprehensive as possible, covering not just how to invest in the strategy, but also on the investment philosophy behind it, how I've invested my own money over the last 2 decades, and much more. Going over all of this will take time. So if you have a question on something that is not covered today, it will likely be answered in later videos. Lastly, throughout this series, I will move slowly. This is by design, because a lot of you may not have a finance background, and I really want the crucial concepts to be hammered home. Also, if I was in my early 20s and investing real money for potentially the first time, this is how I would want the strategy explained to me. And if you find this useful, please hit like and subscribe. It will really help spread the word. Now let's get into it. The way we're going to proceed is I'm going to cover both the details on how to start investing in the strategy and simultaneously flesh out the 5 important assumptions that were covered in the last video at the same time. Let's start with assumptions 1 and 3. Assumption number 1 is your initial investment of $1,000 begins on your 23rd birthday on December 31st, 2025, and an additional $1,000 is added every 2 months moving forward. This effectively means you're investing $500 per month, but the reason I would do $1,000 every 2 months instead is you can buy a lot more with $1,000 than you can with $500. This may sound obvious, but having more money to deploy per transaction has been very helpful to me, especially at the beginning. Now, I know not everyone can afford to put away $500 a month at age 23, but to get the idea across, we needed to make some kind of simplifying assumption for this. The important thing is to figure out how much you can comfortably put away every month without it affecting the kind of lifestyle you want to live. Another thing to consider is while you may start with a relatively small number, over time as your salary increases, you can hopefully increase how much you can allocate to the strategy as well. For reference, my personal allocation to the strategy is a lot higher today than it was 5 years ago. In fact, more than 6 times higher. Moving on. So on December 31st, 2023, day 1 of this strategy, you make the initial $1,000 investment. But what do you buy? This ties to assumption number 3, and we're going to start getting a bit technical now, so bear with me. We're going to buy securities that will allow us to generate 2.7 times the S&P 500 return on a daily basis. This will be done through buying exchange-traded funds, or ETFs, and simultaneously having put options in place for downside protection. Quick note, I have no affiliation with any investment I'm going to talk about in this series. These are just what have worked for me so far. So on day 1, we're going to ideally allocate 98% or $980 of our initial capital to ETFs and 2% or $20 to put options. However, as we will later see, given we are investing a relatively small amount on day 1, it is almost impossible for this exact target allocation to be achieved. And that is perfectly okay. Let's talk about each of these polar opposite securities independently, starting with the ETFs. I'm not going to spend a lot of time today covering what an ETF is. I'll assume you already know, But if that's not the case, just let me know in the comments below and I can go over this topic in more detail in the next video. Now, in our portfolio, we're going to buy 2 levered ETFs. Think of these like the S&P 500 but on steroids, moving around 3 times faster, up and down. The first ETF is called the ProShares Ultra Pro S&P 500. The stock ticker for this is UPRO, UPRO. And the second is the Direction Daily S&P 500 Bull 3X shares. The stock ticker for this is SPXL. The names are quite a mouthful, so we will just refer to the ETFs by their stock tickers moving forward. As we said, these ETFs aim to return 3 times the S&P 500 index return on a daily basis. And from my experience of investing in these, they are pretty damn accurate. So if the S&P 500 index increases by 1% on a given day, based on my past experience, I can tell you it's highly likely that UPRO and SPXL will increase by close to 3% on that same day. But as always, you should do your own research to verify this as well. Also, it should give you comfort to know that these securities are very liquid, meaning if you needed to buy or sell UPRO or SPXL, you could do so at the market price in seconds. As of August 2025, the average dollar value of each of these securities traded on a daily basis is around $500 million. So based on this, you should have no concerns about finding a buyer for your shares should you need to sell. Let me end today's video with how we get to 2.7 times the S&P 500 return with this portfolio. And I'll do this with a simple mathematical walkthrough. We'll do this on Excel rather than on a slide because it'll be much clearer than me just talking about it. I've already entered the formulas on this sheet. So once I enter the initial investment amount here, everything should automatically fill in. There we go. So on the initial investment date, we're going to invest $1,000. We also said ideally 98% of this is going to be invested in the ETFs, UPRO and SPXL. So that's $980. And the remaining 2% or $20 will be in put options. And I say ideally because in the beginning, these allocation percentages will not usually work out, as we will shortly see. One of our other simplifying assumptions that we will discuss in detail later is that the S&P 500 is going to return 9.5% annually moving forward. So if that were to happen, UPRO and SPXL would generate a return of 9.5 times 3 or 28.5%. So at the end of the year, in this scenario, the levered ETFs would have a value of 1259 compared to 980 at the beginning of the year. We're also going to discuss the put options in detail later, but for now, just take my word for it that if the levered ETFs increased by 28.5%, the put options would lose most of their value. And in this case, we assume the $20 initially invested in put options declines by 90% to $2. So adding the 2 year-end values together, we have a portfolio worth $1,261. When we compare this to our initial investment of $1,000, the portfolio has increased in value by 26.1%, which is 2.75 times the assumed S&P 500 return of 9.5%. So hopefully this example was clear, and moving forward, we will stick to our assumption that this portfolio will generate a return of 2.7 times the S&P 500 return on average. Okay guys, so that will be it for this video. As I said at the outset, we are moving slowly by design, and hopefully everything that was covered here was easy enough to follow. It will definitely be an important building block for future videos. The next video will be a bit more technical, and we'll start it with a live walkthrough on Excel on how to calculate exactly how many shares of UPRO and SPXL to buy on the initial investment date. We'll then wrap up the levered ETF section, move on to put options, discuss the rationale behind the remaining simplifying assumptions, and a lot more. Please don't forget to like and subscribe. Thanks again for your time, and I look forward to seeing you on the next one.